Welcome back to The Explainer. Today, we're putting on our institutional analyst hats to break down the latest Nifty Weekly Recap for the week ending June 7, 2026. You know, I absolutely love looking at the markets through this highly structured, data-driven lens. It just cuts right through the noise. But real quick before we jump in, a friendly reminder that this explainer is strictly for educational market tracking and study. We're not giving out financial advice here, and there are absolutely no buy or sell recommendations. We are just here to learn how to read the market's data objectively.
So here's our game plan for today. We'll start with the defensive market regime, then map out the index and options context. After that, we'll dive into cash market delivery quality, touch on data limits and sectors, and wrap it all up with trading discipline and risk. Let's get right to it. Starting things off with Section 1, the defensive market regime. Think of this as assessing the macro weather. We're zooming out and looking top-down at the broader environment. And as this week closed out, honestly, the weather is looking distinctly defensive. Sure, active charts exist out there, but the broader evidence, it's just not supporting aggressive risk-taking right now.
Take a look at the Nifty structure here. It closed down roughly 0.77% for the week at 23,366.70. But the most crucial takeaway isn't just the drop, it's that the index is sitting below its 20, 50, and 200 daily moving averages. That structural weakness is exactly what anchors our caution-first approach. Meanwhile, Bank Nifty is sitting at 54,496.25. It's looking a bit firmer, but it's hovering right near a major resistance zone, which keeps us firmly in a watch stance rather than giving an aggressive green light.
Because of that setup, we're stepping into what's known as a confirmation-led week. Basically, this means we don't try to play hero and predict the next big move in the dark. Instead, we wait patiently for the data to prove itself. Even if the indices break above resistance, if the underlying cash names are still showing weak delivery, the smartest play is to stay cautious. We need price, delivery, breadth, and sector behavior to absolutely align before we even think about stepping on the gas.
Moving on to Section 2, Index and Options Context. Let's map out those pressure systems to find our tactical decision zones for the week ahead.
The options data gives us some incredibly tight boundaries to work with right now. For the Nifty, we've got immediate options-derived support sitting at 23,350 and resistance capping the upside at exactly 23,400. That is a very narrow window. For Bank Nifty, it's almost directly at its resistance area, making 54,500 the practical decision zone with support below at 54,400. Now, keep in mind, because the Nifty expiry on June 9th is so close, the options chain can get pretty noisy, so we're treating these numbers as context, not gospel.
So how do we use those boundaries? We use them to define objective triggers. An improvement scenario only happens if the Nifty can actually sustain itself above that 23,400 resistance and Bank Nifty holds above 54,500, and crucially, that move has to be backed up by market breadth and clean delivery. On the flip side, our risk-off scenario triggers if Nifty slips below 23,350 and Bank Nifty falls below 54,400. If we're just bouncing around between these zones, we sit on our hands. We don't force direction, we just wait for cleaner evidence.
All right, Section 3, Cash Market Delivery Quality. This is where we lift the hood and see what's actually powering the engine.
We scanned 57 watchlist names this week to see if real institutional money is accumulating shares. Take a guess how many candidates cleared the final, strict institutional risk filters. Exactly 0. Not a single name got promoted as a final cash candidate. That right there is a massive data point. There was plenty of activity, sure, but literally 0 names had the required quality of confirmation.
If we break down why they failed, it tells quite a story. 46 names were rejected simply because of low confidence data. The evidence was either incomplete or just too weak to upgrade the setup. The remaining 11 names were kicked out because the broader bearish market regime dragged down confidence, even if the individual chart looked somewhat active. When the macro weather is this defensive, the hurdle for any single stock to pass the filter becomes incredibly high. And when we classify the delivery of those 57 names, the underlying weakness becomes glaringly obvious. The vast majority of the volume out there is speculative. 24 names fall into that bucket, while another 18 names showed low-quality volume. Out of 57 stocks, only one single name showed clean institutional accumulation. Think about that. Speculative volume is absolutely not the foundation you want for a healthy, sustainable rally.
Which brings us to a crucial guiding principle for the week. A technical signal without strong delivery, clean data, and a supportive market regime can quickly become a trap. You might see a beautiful technical breakout on a chart,
but it means absolutely nothing if the delivery quality, the actual institutional money flowing in, doesn't support the move.
For your own educational study this week, try tracking how these specific sets of names behave. On the positive side, we have reads like GVT and DD, CanBK, RECLTD, and Apple. But remember, they are still watch list only right now because of the broader environment. Compare their price action to names flagged with speculative risks like CG Power and Siemens, or those with low-quality risk like ABB and Polycab. Watching how these distinct groups act in real time is essentially a masterclass in why delivery quality is so important.
Next up, Section 4, Data Limits and Sectors. A huge part of institutional analysis is simply respecting the unknowns.
This week, we have to acknowledge some major blind spots. Critical pieces of the data puzzle were simply unavailable in the inputs reviewed. The sector rotation classification is incomplete. Formal advanced decline counts, unavailable. And the breadth counts for stocks holding above their moving averages are missing too. Without clear sector leadership and breadth inputs, we literally have no choice but to downgrade our overall conviction.
As the old saying goes, when sector leadership and breadth are missing, it is better to treat stock-level strength with caution. We don't guess in the dark. We just tighten our risk parameters. If a single chart looks hot, but the broader market isn't there to back it up, that stock is incredibly vulnerable. Knowing what you don't know is half the battle.
Finally, Section 5, Trading Discipline and Risk. Consider this your flight manual for safely navigating a defensive market.
Make this checklist your strict, unbending rulebook for the week. First, absolutely do not chase gap-up openings. Wait patiently for price confirmation around those key levels. Remember, 23,350 to 23,400 for the Nifty. Avoid weak delivery setups like the plague, and just completely skip anything that doesn't offer a clean mathematical risk-reward ratio. And most importantly, if the index starts showing weakness, don't hesitate to reduce your exposure. Keep it calm, keep it process-driven.
I'll leave you with this provocative thought to chew on. When the macro weather is this defensive, when the volume is largely speculative, and when zero stocks actually pass the final quality filter, is protecting your capital actually the most aggressive move you can make? Sometimes, doing absolutely nothing is a highly active strategic decision. Prioritize your defense, steer clear of the traps, and let the data lead the way. Thanks for joining me for this explainer. See you next time.